I'm not a licensed CPA, so obviously we're going to say check with your accountant, but there are benefits of owning a home if you have mortgage interest that's over 27,700. So the married couple deduction is 27,700. Let's just start with a married couple. If they bought a house and took a loan amount of 500,000 and their rate is 7%, their mortgage interest in year one is 35,000. That same client, let's say we're in the state of Illinois, we'll just use that for example, pays real estate taxes of 10 grand. They can write that off only up to 10 grand. They can also write off any charitable, contributions that they make. So I had a client, I'm going to do a real life story, and I actually have it here on my computer. They had a current mortgage, but they outgrew their home. They had 3 children. They couldn't write anything off because their mortgage interest was lower and it didn't exceed the married couple deduction where you can start to itemize. So when we ran their new mortgage payment, I'm looking at it right now, it was going to be $3,800 a month. It was a little bit higher than what she wanted. I had to explain to her, you now have a write-off, 7% rate. Her loan amount's $500,000. I go, you now write off that. You write off your real estate taxes. You write off your charitable contributions and donations. That itemized write-off opportunity for her turned out to be almost $60,000. At her tax bracket, she's going to get back $15,000. With her previous home that she sold, they were not getting any itemized deductions. They just got a standard deduction. That was about $5,540 that they could write off. So that's almost a $10,000 difference, meaning her mortgage payment is $750 less per month because of the tax write-off. You can change your withholdings on your paycheck to bring in more money so that you're not as stressed out about making that payment. Or she opted to just pretend she didn't know she's going to get this money back. So at the end of the year, when she files her taxes, they'll get a chunk of money back, which she said kind of helps her like a forced savings plan or emergency fund. So you can do it 2 ways. You can take it monthly by changing your withholdings on your payroll, or you can take it at the end of the year when you file your tax return with the IRS. Not everyone's going to have a write-off. It depends on your loan amount. It depends on your interest rate. But if you are doing loan amounts that are typically over $300,000 to $400,000 for a married couple, you will definitely have an itemized deduction opportunity with a better tax refund. A single person, I believe the deduction, the standard one, is around $13,800. So again, if you're paying mortgage interest over that, that's all going to become deductible, including your real estate taxes and then any charitable. So there are some benefits that you're not understanding. And I don't know many loan officers that will explain that to their clients, but they need to. And then they need to tell them to go check with their CPA to make sure that, they're agreeing with it and that the write-off is about what we're saying. We typically use a 20% tax bracket just on average to help show the people their tax benefit, but it could be even higher depending on where your income is. So if you have any questions on how it would benefit you to buy a home, what, is your real payment after the benefit of writing off the taxes, feel free to reach out to me. And if you want to subscribe to my YouTube channel for more tips like this, just hit that subscribe button.